Good morning, everybody. My name is Richard Scrow. I am the Legislative Director for the Department of Revenue. So this morning I am going to touch on a few of the tax law changes from the 2020 spring legislative session. I'm not going to, obviously it's not going to be an exhaustive recap, but in your packets there is a document that contains all of the tax law changes that the department tracked. And obviously that were subsequently signed into law. It's also available on our website. But before I jump into some of the tax law changes, I want to provide somewhat of a perspective on just how much legislation the 102nd General Assembly dealt with over their 2-year cycle. So the 102nd General Assembly started in January of 2021, and they're set to wrap up in early January 2023 with the 103rd General Assembly being sworn in on January 11th. But as of October 31st, over 10,000 pieces of legislation were introduced the General Assembly. So as you can see, almost 6,000 in the House and a little over 4,200 in the Senate. So a substantial legislation that gets introduced and that kind of works its way through the process. Just kind of give you an idea of how many pieces of legislation are ultimately signed into law. Right now there are 1,102 public acts that have been signed in the 102nd General Assembly, so roughly 10%. As you can see, not a lot of those that get introduced are ultimately signed into law. How many does the department track? Well, of those 10,000, we tracked 950 of those bills. So quite a few. And if we exclude vehicle or shell bills, and what those are, these are legislation that's introduced that makes a technical correction to a particular act. They work their way through the legislative process, so they're in a position in case they're needed for a substantive amendment late in session. So even if we exclude those, 780 substantive bills were introduced that propose changes to the tax code. So a significant amount of ideas, if you will, that are introduced each year regarding the Illinois tax code. So first of all, we're going to talk about some of the income tax legislation that got passed. And really there is one significant piece of legislation that we'll focus on today, Public Act 102-700, which is commonly referred to as the revenue package. So that particular piece of legislation contained a significant number of tax law changes from the 2022 spring session. First off, we've got some changes to the EDGE tax credit, the Economic Development for a Growing Economy tax credit, added definition for startup taxpayer, and basically that is any entity that has been incorporated or organized within the last 5 years that has not had an income tax liability. So if an entity falls within those parameters, then they're considered a startup taxpayer, and DCO can enter into agreements with these taxpayers. The legislation also provides that startup taxpayers can elect to use that credit against their withholding liability. So, there are times where corporations do not necessarily have an income tax liability, but they will likely have a withholding liability, so they can take advantage of that credit. The legislation also extended DCO's authority to enter into agreements to June 30th of 2027, so basically extended the sunset date for the EDGE tax credit for another 5 years. The revenue package also made some changes to the film production tax credit. Specifically, the tax credit has always been able to be transferred, but this now imposes a fee on that transfer. The fees are going into the Illinois Production Workforce Fund to be used for purposes outside of the Department of Revenue. And it makes other changes to DCO's administration of the credit. So one thing I wanted to point out, just so make sure everybody's understands that when we're talking about DCO's administration of the credit, There are certain tax credits that are administered by other state agencies. Typically, they are given to an agency that has some level of subject matter expertise for a particular tax credit. And so the agencies are essentially responsible for pre-auditing those tax credits and determining eligibility for taxpayers. If they determine that a taxpayer is eligible, they'll issue a certificate to that taxpayer, and then the taxpayers are responsible for then attaching that certificate to their tax return to verify with the department that the credit they may be claiming on the return has been validated with DCEO. And I mentioned that because there was a couple new tax credit certificate programs that were created during this past session. So continuing on with the revenue package, we have the hospital tax credit. They simply extended the current tax credit for certain hospitals for 5 years, so to tax years ending on or before December 31, 2027. They also created a new tax credit, the organ donation tax credit. This is a credit against withholding for employers granting leave for employees serving as an organ donor. The amount of the credit is equal to the amount withheld, but not to exceed $1,000 per employee. And this goes into effect for reporting periods starting on and after January 1, 2023. And as the director alluded to, he had made mention of the tax rebates, which I'm sure we're all familiar with. The revenue package was the vehicle for that legislation, so the real estate tax rebate and the income tax rebates. The revenue package also significantly expanded the earned income credit program. So one of the things it did is it increased the state EIC to 20% of the federal earned income tax credit. It's currently at 18%. It also extends the EIC to taxpayers aged 18 to 25 without dependents. Extends it to taxpayers aged 65 and older without dependents. Also extends it to I-10 filers or those taxpayers who do not have a Social Security number. And all of these changes are effective for tax years beginning January 1, 2023. The revenue package also amended the credit for instructional materials and supplies. So this is the one that teachers, for example, are eligible for if they use their own out-of-pocket to purchase instructional materials and supplies that are used in the classroom. So up until this year, it was been $250. The tax credit increases to $500 starting in tax year 2023. A new credit, and this is one of the credit certificate tax credit certificate programs I'd mentioned. So it's a credit for agritourism liability insurance. It's a tax credit certificate program administered by the Department of Ag. It's equal to 100% of insurance premiums, not to exceed $1,000. And it also caps the amount of credits that the Department of Ag can award in any given year at $1 million. And this is currently is a short-lived tax credit program. So it's actually in existence now. So it started with tax year 2022 and it's set to sunset in tax year 2023. One of the, I guess, more significant pieces of legislation that was included in the revenue package was the MicroAct. So it stands for Manufacturing Illinois Chips for Real Opportunity. So somebody got creative on that one. And this largely mirrors the same tax incentives that were included in the Rev Illinois Act. So if anybody is familiar with that, the Reimagining Electric Vehicles in Illinois that was passed last year, pretty much tax incentives that were in the Rev Illinois bill are in this as well. So just to kind of reiterate what those are, it has a micro Illinois credit, which is basically a tax credit for the incremental income tax attributable to new employees and applicants project. This is also allows for an election to use the micro Illinois credit against withholding. And this is effective for tax years beginning on or after January 1, 2025. So a couple of years until this actually takes effect. Also created a construction jobs credit. So again, this is a credit that DCO can award for labor costs associated with the construction of these projects. This as well is effective for tax years beginning on or after January 1, 2025. And we also have an investment credit equal to 0.5%. And this is very similar to other investment credits that are currently in the tax code. This also is effective tax year beginning with tax year January 1, 2025. Oh, and the other thing I'll mention too with the, on the MicroAct, so those are the income tax changes. When I discuss sales tax changes here in a second, there are some sales tax incentives as well that was included in the MicroAct. And then the last piece of income tax legislation I wanted to review is Public Act 102-1053. This was actually, Senate Bill 3617 was kind of a larger omnibus bill that dealt with human services issues, in particular dealing with substance abuse and mental health issues, but they had a tax credit within that legislation. And this is a tax credit program that will be administered by the Department of Human Services. Some of the specifics of the tax credit program, it's a credit for hiring an individual with a substance use disorder or a mental illness. It's equal to $1 per hour, but not to exceed $2,000 per employee. And it caps the credit awards at $2 million per calendar year. And like some of the other new tax credits, this is effective for tax years beginning on or after January 1, 2023. Navigating or transitioning now over to some of the sales and excise tax legislation. So again, we're back with the revenue package. So we've discussed the income tax changes that were included in the revenue package. So these are the sales tax changes. So they made some changes to biodiesel. So right now, in order for diesel fuel to be purchased tax exempt, it has to contain at least 10% biodiesel or renewable diesel within that. So this bill gradually increases the percentage that must be included in diesel fuel in order for it to be tax exempt. So in April of 2024, it goes up to 13%. In April of 2025, it goes to 16%, and then April of 2026, it will increase to 19%. Now that April date is kind of odd, but the reason for that is because there is, I guess, somewhat of a hold harmless provision in there. So biodiesel tends to coagulate in the winter months if it's above the 10% level. So this provides that during the months of December through March, the tax exemption stays in place for biodiesel that still only contains the 10%. We also have the sales tax exemption for hospitals. So this had a sunset date on it of July 1 of 2022. This bill repealed that, so essentially makes it permanent. We'll talk about another bill in a second here that has somewhat of a conflict with this bill, but I'll talk about that a little bit more here in a second. The revenue package, and again, the director alluded to this in his comment, package also included the legislation that basically held the motor fuel tax rate at 39.2 cents per gallon until January 1 of 2023. And then, so we're set to see an increase to that January 1, 2023 as provided by statute. So it's based upon CPI. Also, the tax suspension on groceries was included in this bill. So basically, food for human consumption that is consumed off the premise, the rate was 1%, and they lowered it to 0% during the for the year of the suspension. I will note this is only the state rate, so there are some local rates that. Some municipalities or other taxing jurisdictions that are able to impose a tax on food available for immediate consumption. And so those rates were not exempted. So there are some taxing districts where there's still some tax on those products, but it's a local tax. Also, this legislation included the sales tax holiday. So as I'm sure we are all aware, there was a sales tax holiday from August 5th to August 14th of this year. Again, just suspended the state's 5% tax rate, so the local tax rate was still in effect on those products, and it was largely meant for back-to-school shopping. The legislation also included a new exemption for breast pumps and breast pump kits, and this has been effective since July 1 of 22. Also extended the exemption for the coal and aggregate exploration, mining, off-highway hauling, processing, maintenance, and reclamation equipment exemption. So that's a mouthful there. And that pretty much explains what the exemption does. So like I said, that's extended until July 1 of 2028 now. There were some changes to the parking excise tax. There was the definition of booking intermediary and charge or fee paid for parking were deleted. And there were also some conforming changes to the definition of operator. So these were some definitions that got included with the legislation kind of at the 11th hour when the parking excise tax was being finalized, created some internal inconsistencies with the bill. So this removed those definitions and those internal inconsistencies. So again, we go back to the MicroAct. These are the sales and excise tax legislation changes. So as with Rev, it creates a building materials exemption from the sales tax acts. Also has several utility exemptions, the telecom excise tax, the electricity excise tax, and the gas revenue excise tax. So exemptions from those three taxes as well. So Public Act 102-886. So this is the one I had alluded to earlier regarding the sales tax exemptions for certain hospitals. So this legislation actually extended the exemption for 5 years until July 1, 2027. So we've got one piece of legislation that has extended it for 5 years. We've got another piece of legislation that has repealed it. So the one thing we know for sure is that it is going to be in existence for the next 5 years. So the General Assembly at some point in time will have to rectify this discrepancy. And for those who've spent any time around the General Assembly, I guarantee probably the earliest we'll see a resolution, a bill introduced for resolutions probably January 2027. So. And then to wrap things up here, I just wanted to go over some of the department's legislative initiatives that were signed into law. First of all, so it was Public Act 102-1019. So the first change had to deal with dyed diesel sales. So some of you, I'm sure, are familiar with dyed diesel, but for those who may not be, the motor fuel tax is imposed upon operating vehicles on Illinois' roadways. So if you're not operating on Illinois roadways, that fuel is not necessarily subject to tax. So with diesel, you can think of a farmer, for example, who may have a fuel tank on his property that he's just going to use for, on the farm. He's not going to use it on roadways. So the diesel is dyed, so we know that that's tax-free diesel. So if revenue agents happen to find a semi-driver who is operating his rig on the highways with dyed diesel, obviously he's going to be in trouble for that because he can't be operating on roadways on non-taxed fuel. So that's what the program is, and the department has always administered that program under the, our interpretation of the language was that all of the entities involved in that had to be licensed and, that the fuel was used by, in an exempt manner by the end user. Recently, there was it was kind of discovered that the language could be read differently to where there were entities, we refer to them as brokers, that were facilitating transactions from the suppliers and the end users, but they were not licensed with the department. So we were worried about potential issues with enforcement. So this particular change just clarifies that you have to be licensed in order to operate within that fuel supply. We also required electronic filing of certain vehicle returns. Probably one of them, the ST556, that's the return that you would complete if you went into a dealership and bought a new or used vehicle. The ST556X, which is the amended version of that return, and the ST556 LSE are some of the more common returns that will fall under that. Now, a lot of dealerships were already filing electronically, but this just mandates that everybody has to now. And then these last two I'll kind of talk about in conjunction. So this has to do with the hearings for the EAV and property tax classes. So currently, statute requires that we have these hearings and conduct these classes throughout the state, and we have to do them in person. And when COVID hit, we couldn't do that any longer, so we conducted these virtually. And if you think about it, like with the EAV hearings, it required that we either hold them in Springfield or Chicago. Well, if you've got somebody who may want to attend that maybe lives in downstate Illinois, they may not, want to travel to Springfield to attend a hearing. So anyway, this allows us to do it virtually now. So obviously this will open it up for more citizens to be able to participate in the hearings and the classes if they so choose. And then finally, this is a pretty easy one, Public Act 102-769. This just cleared up a audit finding. So the department is required to publish its letter rulings once a year. We submit those to the Secretary of State's office for publication. We don't actually publish them ourselves. We had a situation where we had submitted them to the Secretary of State's office, but they didn't publish it until after January 15, so we had an audit citing for that. So this just clarified that we are just required to submit it and not publish it, so pretty straightforward there. And with that, I think I'm actually, am I a little ahead of time, Terry? Or I'm behind? Okay. So, yeah, thanks. So you want me to wait until the end for questions then, Terry? Yeah, so if you guys have any questions, either find me during break or at the end of the conference, just let me know. Thank you very much.